This is Oliver Slope with Blue Line Futures coming to you from the floor of the CME here in Chicago with your grain market update. And we saw a little bit of a reversal in the money flow yesterday, which was pretty encouraging, and a little bit of a silver lining as we look to round out the month going into a holiday weekend. Going into that holiday weekend, we would not be too terribly surprised to see the volume thin out and be a relatively quiet session. Now, with that said, yesterday's turnaround was, again, encouraging for corn specifically. If we're able to continue to defend those contract lows, which we came about a half a cent away from clipping yesterday, I think the bulls have a good risk-reward situation here. Now, the resistance side of things, 381 is going to be the big barrier that they're going to want to jump over. If they can achieve this with consecutive closes in early September, potentially that opens the door for an additional relief rally towards that gap from the recent USDA report that comes in closer towards 392. Some fundamental factors still looming over the market. Colder weather seeping into the forecast, which raises a little bit of concern, especially for that late planted crop. So that's going to be something to keep a very close eye on as well. Ethanol production was actually up last week after falling for several weeks in a row. Also a silver lining. Still a lot more news on that front, I'm sure, over the next couple of weeks that we're going to be hearing from the U.S. Administration, as they've been kind of jawboning as of late, trying to renew optimism on that front. Now, as far as the soybeans are concerned, also fairly upbeat here on yesterday's technical reversal, but really want to see this follow through continue into the holiday week. And if we're able to achieve this, potentially we make a run at $8.90 to $9. Psychologically significant. You also have the 100-day moving average and the 50, as well as the key Fibonacci retracement. I think this is going to be a little bit of a brick wall. Trend line resistance, lower highs and lower lows since June. That's going to be a big barrier to keep an eye on. With the lingering trade concerns or lack thereof an agreement, I think that keeps a lid on any significant rally, but wouldn't be surprised to see relief in the very near term with that cooler weather putting some premium back into the market. Wrapping things up with the wheat market, Chicago wheat still not necessarily sold. We've got a good reversal, but that was likely on the back of spillover positive money flow from corn and beans yesterday, and really not able to feed off of that momentum. We're looking at the Kansas City contract, December specifically, with a little bit more optimistic viewpoint. $3.97 to $4 recent lows, as well as that psychologically significant area. And again, risk-reward ratio I think is favorable here. If we continue to see positive money flow in corn and beans, potentially that spills over into the wheat market. And if you've traded wheat before, you know it doesn't take much to see a 20 to 30 cent relief rally in a relatively short amount of time. So that's what we're looking at to wrap up the week. That's what you should be looking at too. This has been Oliver Slope with Blue Line Futures from the floor of the CME.